season is here and the CRA is patiently waiting for all of us. For most Canadians, this is the one time of the year that we actually stop and ask ourselves, am I paying more taxes than I actually need to? And for most people, excluding me of course, the honest answer is yes. So in this video, I'm going to show you exactly how the Canadian tax system works and share 3 practical ways to legally reduce your taxable income so you can keep more of what you earn. By the way, my name is Adeshola Mi and I'm pursuing my education to become a financial advisor in Canada. And one of the sections in my course this year was the Canadian taxation system. So first of all, let's clear up the biggest misunderstanding about taxes, which is that the more money you earn, the more you get pulled into a higher tax bracket, and by so you pay more taxes. Ladies and gentlemen, boys and girls, that is not completely true. Okay, Canada uses what is called a progressive tax system, which means you only pay the higher rate on the portion of your income that falls inside that specific bracket and not on your entire income. So let me show you what that looks like using the federal tax rate for 2026. The first bracket covers income from 0 to 58,523, taxed at 14%. The second bracket covers income from 58,524 to $117,045, taxed at 20.5%. The third bracket ranges from $117,046 to $181,440, which is taxed at 26%, and the rate continues to increase as income rises. Now, let's say, for example, you earn $70,000. Does that mean your entire $70,000 is taxed at the 20.5%? No. What happens is that your first $58,523 is taxed at 14%, which comes to roughly $8,190 in federal tax, and the remaining $11,477 is taxed at 20.5%, which works out to about $2,350. When you add those together, your total federal tax comes to roughly $10,550, which is only about 15% of your annual income and is considered your average tax return. Your marginal tax rate, however, is 20.5% because that is the rate applied to the next dollar you earn. So as you can see, you are not paying 20.5% on your entire income, but only on the portion that falls into that bracket. Now, here is a question for you, and I want you to answer this in your head so you can always remember. Ask yourself, based on my annual income, what is my marginal tax rate and what is my average tax rate? If you're able to answer this correctly, then I have served my purpose in this video, so make sure to give me a thumbs up. Once you understand these, you realize that the only true way to keep more of what you earn is by reducing your taxable income or shifting your income out of the higher tax bracket altogether. And that brings us to one of the most powerful tools available to Canadians: registered accounts. In my course this year, I also learned a lot about registered accounts, and these are essentially government approved investment accounts that offer tax advantages designed to help you grow your money and protect your money even more. Each one works a little differently, but the goal is always the same, which is to reduce the amount of tax you pay over your lifetime. Let's start with the RRSP, which is the Registered Retirement Savings Plan, because this is where people usually see the most immediate impact. What I like about RRSP is the fact that even though the government is giving you the account, they're basically still letting you lower your taxable income. RRSP contribution reduces your taxable income dollar for dollar, which means every dollar you contribute lowers the amount of income the government can tax. So let's go back to our $70,000 example for a second. If, for example, the person earning $70,000 contributes $10,000 to their RRSP, the government now taxes them as if they only made $60,000. Before the contribution, part of their income was being taxed at the 20.5%, which is their marginal tax rate. After the contribution, the large portion of the income that is being taxed at 20.5% now disappears. So instead of $11,477 being taxed at 20.5%, only $1,477 $10,477 would be taxed at 20.5%. And by so, instead of paying $10,550 as taxes, they would now be paying about $8,500 only as federal tax just by contributing to their RRSP. But it gets better. Once the money is inside the RRSP, it grows without being taxed every single year. No tax on capital gains, no tax on dividends, no tax on interest, and you only pay tax when you withdraw the money later on in the future, ideally in retirement, when your income is lower and your average tax rate drops. That makes sense. So what you're really doing is saving at a higher tax rate today and most likely withdrawing at a lower tax rate tomorrow in the future, and that gap is where long-term wealth quietly builds. Now, does that mean the RRSP is always the first place your money should go, or does that mean you should run off and throw every single dollar into an RRSP? Well, not necessarily, and this is where a lot of Canadians get it wrong. Let me introduce you to the TFSA, which might be one of the most misunderstood accounts in the country. I made the mistake as well when I first came here. Okay, like it's pretty normal. With a TFSA, also known as a tax-free savings account, you contribute money that has already been taxed, so there is no deduction upfront. But from that point forward, every dollar of growth inside the account is completely tax-free. If your investment double, tax-free. If you withdraw the money later, tax-free. If the account becomes very large over time, still tax-free. Imagine building an investment account that the government will never touch again. That's the power of the TFSA. TFSA is valuable for people who expect their income to rise in the future because you are choosing to pay your taxes now while your rate is low. It also gives you flexibility since withdrawals do not increase your taxable income or push you into another bracket. Say, for example, you are new into the country and you know you're probably not going to make $50,000. I would most likely to the TFSA. Okay, just so you know, the fact that it is called a savings account doesn't mean you cannot invest in it, because that is why it's been misunderstood. Actually, the best way to fully utilize it is to invest inside your TFSA. I'm going to link a video here. I think it's here. I should know where it is at this point. I'm going to link a video here and in the description box to learn more about the TFSA. I made an entire video about it, and you can let me know if you have questions about TFSA. I read an entire textbook about it, so I do have a lot of knowledge about it. Okay, now if owning a home is part of your plan, there is another account you should seriously pay attention to, which is called the First Home Savings Account, FHSA. The FHSA gives you the best of both worlds. Actually, contributions are tax deductible like an RRSP, your investments grow tax-free, and withdrawals for a qualifying home purchase are also tax-free. In simple terms, it is one of the most tax-efficient ways Canadians have used to purchase a home, and all thanks to the government. But like, they give you something, they take something from you. Kind of like that. You can also contribute up to $8,000 per year with a lifetime maximum of $40,000, and unused annual room can be carried forward up to 1 additional year. Now, here is a quick tip that many people miss. Make sure you open the FHSA account as early as possible, because the contribution room only starts accumulating after the account is open, even if you're not ready to fund it yet. Now, the question becomes, which account should you prioritize? If you're earning a higher income today and sitting in a higher bracket, the RRSP often makes immediate sense because that deduction is more valuable to you right now. If your income is still growing, the TFSA can be incredibly powerful because it creates a pool of tax-free money for your future, which is what I personally currently do. And if you're buying your first home, the FHSA is very difficult to ignore. The whole point of this is not to chase perfection. The point is to stop operating on autopilot, because autopilot is very, very expensive when it comes to your taxes. Okay, clock it. Now, beyond the registered account, there is also something called tax credit, and I'm going to keep this very simple because you do not need to become a tax expert to benefit from this. Up until now, we'll be talking about reducing taxable income. However, tax credit do something different. Instead of lowering the income that gets taxed, they directly reduce the amount of tax you pay the government. So let's go back to the $70,000 example we used earlier, right? Based on the federal bracket, the tax you pay to the government comes to roughly $10,500 $550. But because every Canadian is eligible for the federal basic personal amount, and in 2026 the maximum amount is $16,452, which I think is the same for last year as well, the government applies the lowest federal rate of 14% to calculate a non-refundable credit of roughly $2,300, which directly reduces your federal tax payable. It's a lot of information right now, but everybody in Canada, all of us, me, you, your mommy, your daddy, as long as we are all working, the maximum amount is $16,452. That means about $2,300 disappears from your federal tax bill automatically, and that is thousands of dollars quietly saved every year without any action on your part. As you move into retirement, even more credit becomes available to you. So I don't want you to worry about this tax credit because you cannot calculate it. The government has a way of calculating it, and it's applied to your taxes. Okay, also, for example, there is also federal pension income when you become older, which allows you to claim up to $2,000 of eligible pension income, and since it is calculated at 14%, maybe in the future that can reduce your federal tax by up to $280. Beyond that, Canadians can also take advantage of income splitting. So say, for example, let's say in your household you're earning $70,000 and the other person who is your husband is earning $40,000, or anyhow, by contributing to a spousal RRSP, the higher earner can reduce their taxable income today. So if the $70,000 earner contributes $10,000 to a spousal RRSP, the taxable income drops to $60,000, and they end up paying less taxes at the end of the year, even after considering the basic personal amount tax credit, which reduces even further. Meanwhile, the lower earning spouse will withdraw the money later, likely at a lower marginal rate, so the household overall keeps more money. But honestly, this strategy of using the spousal RRSP is mostly beneficial when there is a meaningful difference between the two spouses' expected retirement income, because without that future income gap, the tax advantage becomes really minimal. So if you don't think there is any future splitting advantage, the spousal RRSP adds complexity without any extra benefit, in my opinion. Okay, now we cannot talk about taxes in Canada without mentioning real estate, because for many Canadians, their primary residence becomes their largest asset over time. Not me though, because I don't know if I want to buy a house. But thanks to the principal residence exemption, when you sell a qualifying primary residence that you lived in for the years designated, the capital gain is generally tax-free at the federal level. Some homeowners have seen their properties increase by hundreds of thousands of dollars and paid zero tax on that growth. Opportunities like that are kind of like rare, if you get what I mean. That said, do not let all your wealth get trapped into one place. A home is important, but so is having investment and accessible money. Real financial strength comes from balance. Don't buy a home when you cannot afford to finance a home or take care of the home or pay other bills. Okay, big takeaway here is simple. If you understand your marginal rate and use accounts like RRSP, TFSA and FHSA wisely, you can legally reduce how much of your income gets taxed. This is not about finding loopholes, but about being intentional with your money and planning instead of reacting once in a year. We don't want to do that. Everything in this video is legal, but make sure to consult a tax expert should you need more details. This video is strictly for educational purposes, and if it helped you to see the system differently, make sure to subscribe, give it a thumbs up, and I'm going to see you in my next one. Stay safe, stay fabulous. Peace out.